Okay. Welcome, everyone. So my name is Callum Lang. I'm the CEO of MBH Corporation. This is an event that we have put together for our investors and their friends. It's something that I keep promising that we're going to do more regularly, and then time just seems to slip past ever increasingly. But what we've done is we've invited our good friend Mark Matthews to come and join us, who chief economist at Julius Baer Private Bank. And we've had Mark on before, fantastic guest, and always learn lots of new things from you. So this is I think every time we meet, it's there's a lot of stuff going on, but yeah, there seems to be huge amounts of things going on once again. So I'm very much looking forward to your take on what's happening in the economy, and hopefully some pointers for where our investors can look. So with that, I will give the floor over to you, Mark. Thank you very much.
Thanks, Callum. Can I just check that, which screen are you seeing right now? Are you seeing one with 2 slides on it or one?
We've got 2 slides. We've got your...
Okay, I'm just going to stop that. I apologize, and let me get the correct one.
Oh, that's all right.
Now, do you see one?
Yep, just one screen.
All right.
Perfect.
So thanks for the kind introduction, Callum. And just one clarification, I'm not the chief economist. I'm the head of research in Asia. Just because I know you're recording it. So I have, believe it or not, 103 slides. I don't think I'll get through all of them. Some of them are disclaimers, but I better get started in the interest of time. I want to say, basically, we think the bottom in the market was 2 weeks ago. And we think that there's upside from here. And there's a bunch of reasons for that. The first is that we've already gone through what I'm about to show you is one of the worst periods in markets in history, literally. The second point is the biggest reason why markets went down was, of course, the change in monetary policy due to high inflation. We believe the inflation is in the process of coming down very quickly, and that the Fed is increasingly under pressure to dial back its very hawkish stance. Another thing I want to talk about quite extensively is the dollar, because the dollar, in my mind, is the chief barometer for markets. And I think the dollar will peak and roll over toward the end of this year or the very beginning of next year in January. And the last thing, if I have time, I want to touch on the earnings, because ultimately what moves share prices is their earnings. And the earnings in the third quarter are beating expectations. And I want to make you aware of that, simply because everybody was expecting the earnings to be very bad. I'll start with a little levity. This is the sort of, we thought after COVID and goodness knows what, that we would return to normal, but 2022 has been anything but. And it looks pretty dark out there. But at the same time, that's been amply reflected in financial asset prices. So that's the first point I made, that I will show you right now the data, which is that we literally have had the worst year ever. And when I mean that, what I mean is, if you look at the bottom right, and so there's 3 columns in each of these that are the S&P, in other words, stocks, the 10-year treasury, and a 60-40 portfolio, which would be 60% S&P and 40% treasuries. So the returns of each of those every year since 1928. My point would be on the bottom right that this is the first time in history, first year in history, that both stocks and bonds have given double-digit losses. And you could check that out later, but literally that did not happen before. The second point, which is the years that are highlighted in yellow, is that there were only 4 years previously when both stocks and bonds were down. So barring some miracle, that will also be the case this year. And there were only 4 years on record when that happened. Now, what I would like to do is draw your attention to not the yellow ones, but the ones that came after. In other words, we've got 1931, so 1932, 41 and 42. 69 and 70, and then 18 and 19. So starting from 2018, you can see that the year that followed, a 60-40 portfolio was up 23%. And now if we look at 1969 and the year after that, 1970, the 60-40 was up 8.8%. Then we look at 1942, which came after 41, that was up 12.4. The odd man out is 1932, following, the dreadful year of 1931. You had another negative year because of stocks, by the way. The bond market was up, but stocks and the total return was down 1.7%. Now, the point I'd like to make is 1932 was literally the worst year in the 20th century for the economy in the United States. It was the deepest, darkest moment of the Great Depression. It was also the year that FDR started the New Deal. And even after, such a horrible thing as 1931, even being in the deepest, darkest part of the Great Depression, you actually only lost 1.7%. And so I think the downside is very limited. And at the end of this, I'll show you some more charts to illustrate that. But to come back to the point I made about the Federal Reserve and how hawkish it's been, I think, also a shock, because going into this, the Federal Reserve of 2021 was one of the most dovish on record. And nobody expected Jerome Powell, who's a very wealthy man. You can see that his wealth was well over $100 million when he took the responsibility on of being chair, much greater than any of these other people. People, thought, well, if he's got so much invested in the game, he's not going to want to destroy his own portfolio. And of course, that was absolutely incorrect. And specifically, almost a year ago, it was December of 2021, they did a 180-degree turn. And that was shown in the Fed minutes that came out on the 3rd of January, where they literally went from being uber doves to uber hawks in a month. And nobody expected that. And I think it took a while for us to realize they were deadly serious. And indeed, we can see the dark black line on the left shows this has been the most aggressive tightening cycle since 1987. Before this, we would get even more aggressive ones, which were obviously Paul Volcker in the early 80s. But over the last 35 years, this has been the fastest on record. And you can see the little red words at the tips of the others, that they typically were preceded by some crisis or another. In fact, going forward, the Fed is still committing to raising rates. So it's not like that black line is just going to stop there. They say that, by the way, this is the dot plot. So I don't remember how many dots there are in each of these. If you're good, if you've got quick eyes, you can count them. I think it's 16 or something. But basically, it's showing what each Fed official expects the interest rate to be, both this year, which is on the left, and then you can work your way toward the right next year and 2024, etc. So I want to say that this year they're looking for the interest rates to be even lower than next year. Next year, you can see they've got them going up. Some are looking for as high as 5%. And this year and next year are kind of bunched together. And then 2024, it gets much looser. So you can see that some people are looking for rates to fall a lot. Some are looking for them to not fall at all. So there's less of a consensus, I would say. But generally, the view is that rates aren't going to come down until 2024. So we've got another at least year of high rates. And the market is pricing in a terminal rate, if you look at the top right, of about 5%, which is the upper part of the dot plot. Beyond that, some people are going way out on a limb and saying, why couldn't it be way higher? I mean, Volcker took it to 13. Why couldn't Powell take it to 13? So the Taylor rule is a way of estimating what the correct policy rate should be based on inflation and several other barometers. And you can see the light blue line shows that according to the Taylor rule, we should be possibly up as high as 13%. And Bank of America put this out here just to really show that we're way in the deep end with this, because unless you're 80 years old, you didn't go through something like this. because, you know, you'd be retired by now if you'd been in the market back in 80, 81, 82. So then the question is, why is it happening? Why are they raising rates so aggressively? We know it's because of inflation. And I think there's a psychological component to it, which I have a feeling I showed this when I was last on, but I'll repeat it. Jimmy Carter riding a horse through town, and he's saying inflation is coming, and the townsfolk are saying it went that way. So there's a psychological component, I think, to it, in that you know, when you get inflation, people get angry at you, and they think that you caused it. And Carter has gone down in history as being really one of the worst presidents. I hate to say it, very dear man, but the reason is because the economy was miserable under him. But after him came Reagan, who obviously is remembered as a great president, and the chair of the Federal Reserve, who Reagan appointed, was Paul Volcker, and he rose rates, as I said, all the way to 13%. At the time, people didn't like him, but he's really gone down in history as, I think, the only one of the 16 Fed chairs who's remembered as some kind of St. George who slayed the dragon. Nobody really remembers the others. And I'm sure that our memories will fade quickly over, you know, Bernanke and Yellen and Greenspan, et cetera. But if I said Arthur Burns, you know, you probably wouldn't even know who I was talking about. That was the Fed chair back in the 70s. So when Volcker died in 2019, the New York Times wrote this obituary, which was, you know, just lionizing him as a great saint. And I can't think of anybody else who's ever worked in finance who's been recorded with such posterity. By the way, he wrote a book, which it's the third column mentions it, the third paragraph, in 2018, the year before he died, called Keeping at It, The Quest for Sound Money and Good Government. And some astute observers have noticed that Jerome Powell's been using the term keep at it a lot recently, which, you know, kind of makes one think that he's probably reading the book or he read the book, but you can see the book is all about a breakdown of effective governance and the fact that not enough qualified and committed public servants, and good policies dependent on good management. So I think that there is a psychological thing going on where Powell might think, well, people don't like me now, but I'll be recorded as you know, one of the greats because I will be the one who slays inflation. The problem is that there are side effects. And so one is the financial markets, and Bank of America has a credit stress indicator that is just below the level where dysfunctionality occurs. And of course, we've seen Credit Suisse and the pension funds in the UK. And as Warren Buffett said, when the tide goes out, you see who's been swimming naked. So there's surely more than just two. The second thing is good old-fashioned recession. So this is the yield curve between the 10 and the 3-month Treasury yields, and it went negative last week. And if you look back in history, the gray bars are the recessions. So it was followed by a recession in every instance since the 1970s, albeit with a very long lag. You can see on average a 24-month lag. This time, I think, has been so unusual that it's very difficult to know if the yield curve is still has this good predictive quality. And maybe if it does, the lag would be much shorter than it has been on average in the past. We don't know. But there are clear signs that the economy is slowing down. Apple just said they're reducing the amount of iPhone 14s that they plan to make, for example. And so there's a lot of pushback. There's a lot of pressure on the Fed. And I won't read through every article, but I'll just show you that, for example, the former chief economist at the IMF said that central banks are underestimating the speed that inflation is going to fall as their economies slow. They're all raising rates at the same time. It's going to make a big problem. Here we've got the top diplomat at the EU, Joseph Borrell, and he said that other central banks are being forced into raising rates to protect their currencies from being devalued, and that makes life much more difficult for countries that have to import things. But this synchronicity of central banks is unlike anything seen in 50 years and could also cause a recession. Here's Greg Mankiw, economist at Harvard, and he said, you know, this is what was her name? Abby Joseph Cohen used to say in the 90s, super tankers. So he said that steering the economy is like steering a large ship. Move slowly. Once you return the hell to normal, it keeps going because it's such a big ship. So don't overdo it. And at the bottom, a prominent and powerful liberal lobby group in Washington, the Groundwork Collaborative. So here's a representative of the Groundwork Collaborative saying that this is like the proverbial pot slowly boiling, and the frog that's sitting in it doesn't even know it's boiled until it's over. And so she's saying that about the economy this time. And last but not least, Jeremy Siegel, one of the very famous business professors, saying that he thought the Fed did far too much stimulus in 2020 and 2021. Now it's moving far too much in the opposite direction. You can see at the bottom, he said, I see inflation going down everywhere. And the Fed saying they're going to be tighter for longer means a deep recession. Actually, that's not the last one. The last one is Ed Yardeni. He's another old timer. He was a Fed economist in the 1970s. But you can see at the bottom, he says, I'm totally stumped, mystified, surprised that officials at the Fed don't acknowledge that raising rates so much, quantitative tightening, and soaring dollar, you put all those together and you're asking for a big problem. And so he said that he just sees one more rate hike coming, which would be at the next FOMC on the 4th of November. And then that's it, because between now and then, financial stability will pop up as a primary concern. Actually, he said that back on the 3rd of October, and that was before Credit Suisse and the BOE, et cetera. What I would say is that normally I would agree with Mr. Yardeni were it not for politics. And the problem is that here's why I want to show you why I agree with him. Definitely inflation is going to come down. The problem is that there's two lines here. The first is the actual inflation rate, which is the purple line. And the second is Citigroup's inflation surprise index. So the inflation surprise index has collapsed. In the past, it has led the actual inflation very nicely. This time it will too. But the average person on Main Street, the average American, they don't see that light blue line. They just see the purple line, which is still very high. And so for the Federal Reserve to declare victory now with inflation stuck way up there where it is on the top right would just look very politically incorrect. And it would be asking for trouble for the White House as well, and for the Congress, which is about to have an election. But what I would say is that I want to show you a few things why inflation is coming down. And the first is that there's two main components, flexible and sticky. So the sticky stuff is the problem. It's the blue line that's going up there. It's actually the highest since the early 80s. But the flexible, which was responsible for the lion's share of the inflation, it clearly peaked and it's coming down very fast. And for example, we can see global freight rates are down about 80% from their peak. And so the supply chains are normalizing. And we can see, therefore, the purple line shows you backlog of work is falling, and the brown line shows you delivery times are improving. And so that means prices are starting to come down. You might remember that during COVID, because of the shutdowns in factories and all the ports and the containers were taken offline, that there were no new cars for a while, also because of absence of semiconductors. And so people had to go about and buy new cars. And at one point last year, around this time last year, new car prices were rising at about 50%. Now, actually, they're down 10%. It's the biggest they've dropped ever in the history of this series. So if we back it up, we rewind the clock and look what happened prior to COVID over on the left. Services were where the inflation was coming from, and you had almost no goods inflation because of China, globalization, technology, etc. Then what happened is you had this big hump with the blue going up with COVID, with lockdowns, with supply chain disruptions, etc. And that's now going down now and will continue to go down. But what the baton has been passed to the services. Services are the problem. And really, the biggest one is what you can see on the left, shelter, which means property. And the Fed measures that primarily through rent. So a third of the CPI basket is basically property. And I think it's going to go down. So the first thing is that the mortgage rates have gone up a lot. That's on the right-hand side of the chart on the top. They've doubled, in fact, more than doubled. And so mortgage applications are falling. A house that cost $600,000 last year, you only had to pay a 3% mortgage rate for. And so assuming a 20% down payment, you were paying about $2,000 a month. That same house is worth a little less now because prices have peaked, as I'll show you momentarily. But your interest rate now, if you're getting a 30-year fixed interest rate, is 7%. And so your monthly mortgage payment will be well in excess of $3,000. Another way of looking at it is that the current cost of getting a mortgage now, assuming a 20% down payment for the average home, is the equivalent of 95 hours of wages a month. The average American works 136 hours a month. So that's basically 70% of their salary. So if you had a double income, you could cut that in half, obviously, but even 35% is still much higher than the golden rule for a mortgage, which is that it should not exceed 28% of your income. So prices are coming down. The red line is prices so far this year, and they are down about 6% from their peak in June. And I think they're going to come down more for a bunch of reasons. I can show you, first of all, when we look at the homes that are listed for sale right now that have seen price drops in the past month. That's the red line for this year, and it's rising quite quickly. You can see in the previous years it didn't go up much. People didn't have to cut their prices to sell their homes. In fact, there are quite a few cities where the home price is down in excess of 10% from where it was in May. Oakland being a suburb of San Francisco, San Jose, capital of Silicon Valley, Austin, fourth largest city in Texas, Seattle, San Francisco, Washington, D.C. So you can see that. And this shows you the traffic of prospective buyers to visit homes for sale has collapsed. So that's another signal. Survey asking, where do you think house prices are going to be a year from now, higher or lower? So most people saying very unlikely they're going to be higher. And it takes a few months, it takes about 6 months at least for lower property prices to feed into lower rents. But ultimately they do correlate because landlords base the rent that they charge tenants off of the value of their property. So rent prices on a sequential basis have been dropping for quite a few months in a row. This is according to Zillow, but you can see it's not in negative territory yet, according to Zillow. But according to apartments.com, actually, most of the 40 metro areas in America did register negative asking prices in the month of August over the month of July. And that's only up until August. So I'm pretty sure that September, when it comes out, will also be negative. Anyway, we do a model where we compare property prices with the rent component of the CPI basket, and backtesting that, it does show that that component of the basket should come down quite quickly. I just also want to touch very briefly on surveys, which are showing a similar story. So University of Michigan has one of the biggest consumer sentiment surveys. Expectations for inflation, both 12 months and over the longer term, are rolling over and coming down. New York Fed does a similar survey, rolling over. And if we look at the prices paid in the Manufacturing Purchasing Managers Index, the prices that companies say that they're paying for goods, that you can see on the top right, it's rolling over. And that is a pretty good relationship with the actual headline CPI, which is on the bottom. The Fed also has said that they think the labor market's too hot and they want it to cool down, and it is. And what we see is job openings divided by unemployed workers. And so that peaked and it's coming down. But those job openings, there's probably less of them than the official numbers show, because often when companies are advertising, they'll advertise in 4 different places, or when they've hired the person, they don't bother taking the ad away, et cetera, et cetera. But the job market is strong. I'm not denying that, but it's softening. So I want to just say that we think inflation is going to come down, and those are the charts that I wanted to show you to illustrate why. But as for the actual Fed funds rate, the interest rate, and when does that peak? Really, the canary in the coal mine historically has been the 2-year Treasury yield, which a year ago was at 0.5%. And this year it is at 4.5%. So that's pretty much the fastest move on record. And if we look back at previous tightening cycles, which are the y-axis from the top to the bottom on the left, what you can find is that usually, not always, there were 2 that it didn't happen, but usually the 2-year Treasury will peak a few weeks before the Fed goes on hold. And so let's just watch the 2-year Treasury. But my best guess is that the Fed will go on hold not next month, because that, as I showed you, inflation is still too high. But if we get a decent move down in inflation for the month of October, which is obviously the month we're in now, and that reading would come out in November, then I think in December, there's a good chance that they could say, you know what, we think we can start taking it a little bit easier. And there's already some cracks in their armor. For example, last week, The vice chair, Lael Brainerd, said that, I'm just going to quote some of the things that she said, "We'll be learning as we go, and our assessment will reflect incoming data, both globally and domestically." And I'm just going to continue reading. She said that we're aware that there are cross-border effects of the movements in interest rates and exchange rates. So clearly acknowledging the skyrocketing dollar and the fact that interest rates are going up around the world and worsening balances. And she said the Fed's dot plot is very helpful at a point in time, but things can change. I think that's quite an important statement for her to say things can change. And then Chicago Fed president there on the bottom saying front loading was a good thing. In other words, I'm glad we raised rates really, really quickly, but overshooting is costly too. That's what he said. And so you might say, well, they can't just go from black to white in one meeting, but actually they can. They did it in January. And I just want to show that the Reserve Bank of Australia did so. That's what they did this month. So if we look at the policy statement in September, they were saying, oh, global factors explain much of the increase in inflation. Domestic factors are playing a role. There's still widespread upward pressure on prices from strong demand, tight labor market, capacity constraints, quite bearish. Now we can see in October, a few weeks ago, they said, well, there's uncertainty in the outlook for the global economy. It's deteriorated recently. Household spending is responding to the tighter financial conditions. Dovish, and actually they were supposed to hike by 50 basis points. They only did 25. I think that was probably the last, because we also see that property prices, particularly Sydney over on the left, have been falling quite a bit, which is what they wanted to see. So basically, inflation is coming down and the Fed will go on hold. That's the central message I want to communicate. But I also said that I wanted to spend some time on the dollar. So once again, to inject a little levity into it, can you make it in dollars? The robber's asking the cashier. You know, sometimes when you see something like a cartoon, it's fun, obviously it's funny, but it's telling you that this is something that a lot of people have already got in their psyche, that the dollar is already gone up a lot. And so that's in my mind actually a rather significant thing, that we're getting cartoons about the dollar, which we don't usually. But the dollar is profoundly negative for asset prices. And as a case in point, over the last 12 months, what I've done here is I've just turned the dollar upside down. So the blue line actually is going up, but I've inverted it to show you that particularly over the last 12 months, we've had a very strong inverse correlation between the dollar and global stocks. And we can also see in the US stock market, companies that have foreign exposure that drive most of their revenues from overseas have underperformed those with US exposure because the dollar's been strong. And 40% of S&P revenues do come from overseas. So dollar is critical for stocks. And here I want to say that we've had a 45-degree angle for the better part of this year. And let's just watch that. If it rolls over, that's extremely positive. And if it doesn't, it's not good. But it has been the strongest dollar, at least in the last 20 years. You can see all the gray lines or the seasonal average of what seasonally what the dollar's done. I mean, there's no real average there. It's all higgledy-piggledy. But you can see the black line shows you quite clearly that the dollar has been the strongest this year that it has at any point in the last 20. And now, instead of looking at it on a seasonal basis, what I want to do is show you the 12-month rolling average of the dollar going back to 1982. So that's to say today's dollar price divided by where it was a year ago. And then you do the same for yesterday versus yesterday, a year ago, et cetera. That's a 12-month moving average. And we can see that it's at 20 now. So the dollar is 20% higher than where it was on the 20th of October, 2021. And that has not happened often before. You had the Plaza Accord, the global financial crisis, and when the Chinese devalued the yuan in 2015. And yes, the dollar did go higher, but it didn't last long. And then it was sort of like a parabola, you know, that went right back down very quickly. And my sense is that could happen this time because 2/3 of the dollar index is the euro. And the Europeans have an even bigger inflation problem than the Americans do. Theirs is running at about 10%. So we think, if you look at the chart on the left, that in January, the baton will be passed, so to speak, from the Fed to the ECB, and the Fed's tightening will be largely done, whereas the ECB will start tightening more. And when you raise rates more than your peers, typically your currency will appreciate. And so on the right, we are looking for the euro to stabilize and then rebound in the beginning of next year. I mentioned cartoons and their utility is just sort of a contrarian indicator. The front page of magazines is similar. And here's the front page of Business Week in 2019. Is inflation dead? Well, we know what happened. Here's the front page of the same magazine 3 weeks ago. And here's the same, not the same magazine, but here's Barron's 2 weeks ago. So, you know, I put that out partially in jest, but not entirely. Because everybody knows the dollar's been strong, and in fact, it's very expensive. So the most simplistic way to value a currency is purchasing power parity. How much does something cost, like a Big Mac, for example, in New York? How much does that same Big Mac cost in London or Singapore or Tokyo or wherever? And so we can see on the far right that the dollar is very, very expensive using purchasing power parity compared to other major currencies in the world. I would also say that I did mention the dysfunctionality that's starting to occur in financial markets, and we saw a taste of that in the UK. It is early days, but it looks like the market likes Rishi Sunak, and the pound's volatility is decreasing. I think I'll just leave it at that because I'm not entirely sure. And I did point out in the text above that it's shocking but true. Britain has $118 billion in foreign exchange reserves, which is about the same as Malaysia. Singapore has almost 3 times as many. Hong Kong has 4 times as many. But I'm going to sort of round off with the markets. And here's the S&P. And at the bottom right, you can see what we think is the beginning of a floor. And we think, as I said, that happened 2 weeks ago. We want it to go sideways, actually. We don't want it to go whipping back up. Because when you go sideways and you build a horizontal base, you build a nice foundation. Like a house, you put in a solid foundation and then you can build on it. If all of a sudden it's a V, you don't have that same technical strength. But I would point out technically that it's very important. The S&P, now we're looking at a much longer term chart, bounced nicely off its 200-week moving average, because when you go below such a long-term momentum indicator like we did on the bottom left in the global financial crisis, then you know the bottom falls out of the market. But we bounced very smartly off of that. Valuation wise, we're on 17.5 times last year's earnings, which is the red horizontal dotted line running across the middle of this chart, showing you the price earnings ratio going back to 1960. That actually happens to be exactly the average since 1960 of the stock market's trailing price earnings ratio. So I don't think we are expensive, and I don't think we're cheap. I think we're just fair value, frankly. But what people want to know is not trailing earnings. They want to know about future earnings. The good news, I would say, is a little bit like the magazine indicator, magazine cover indicator. Everybody already thinks it's the end of the world. So if we look at Bank of America surveys fund managers, and one of the questions they ask is, do you think profits will improve over the next year? And really a record number of them say, no, I don't think so. So in other words, you know, they already expect the things to be lousy. They won't be surprised if they are. And actually, I don't think things will be as lousy as they make them out to be, because the analysts have already downgraded the third quarter by 8%, which if you look at the bottom right is the little gray diamond, X energy. You see it says minus 8%. And that's the downgrades of third quarter earnings that the analysts did during the third quarter, which you can see, apart from the pandemic, pretty much the biggest cuts that they've done pre-earnings season. And so now we're in the middle of the earnings season, and 20% of the S&P companies have reported. Lo and behold, they're beating expectations by 72%, which is, I admit, below the average of the past 5 years, which is a 77% beat. And I'm sure you've heard this one before, but companies intentionally lowball their earnings going into results so that they can beat them, and then they look, you know, they look really good and their share price goes up. But so it's not 77, but it's still 72, which is far higher than I think anybody had anticipated, because everybody was looking for massive margin compression due to inflation. It just has not happened. We do have the big tech stocks reporting this week, so we'll watch those closely. My sense is they will beat expectations. But it is a bear market. And typically, if you look at the second row from the bottom, bear markets last longer than this one. This one is 195 days and down 25%. Typically, bear markets are down 38% from top to bottom, and they last 318 days. At least that's since 1929. So you must know that the sentiment is still, look, it ain't over yet, because there's all these problems, tides going out, Fed's hawkish, da da da. I would say some of it depends on the economy, because if we look, this isn't since 1928, but this is since 1945. When you have a recession, on average, the bear markets are more severe, and that's totally intuitive. So on the bottom, is there a recession? That's the table on the bottom. Then on average, you go down 34.8. If you don't have a recession, on average, you go down 23.8. What I would say is that I won't discount the fact that it could be a recession. Our own house view is, for the time being, that in the United States, there will not be one. But if there is, our view is it'll be very mild, because the labor market is so very strong. And we've been really surprised by the resilience, the ability of the consumer to withstand these major price increases. And that's been shown in the results that are coming out from companies, actually, that they're, I just showed you their earnings, but their revenues are beating expectations too. And generally, the mood on Main Street is not that bad. So that could change, but for now, at least, I would say if we have a recession, I wasn't around in 1948, I wasn't around in 1956, I was around in 1990. I remember that one. And in 1990, the market went down 19.9%, the savings and loans crisis and first Gulf War. It lasted about 7 months, and it wasn't that painful. And I think that if we get a recession today, it'll be something similar. Frankly, we've already factored it in, because we're down, in excess of 20%. A few other things I'll show you on the market are, first of all, this is among the worst years on record for the first 9 months of the year. And if you look at the subsequent performance into the end of the year, with the exception of the global financial crisis, there was a rally. I would also point out that since 1932, the month with the most major market bottoms, in other words, end of the bear market, was the month of October that we're in now. And since 1950, we can see that on average, the best months of the year are toward the end of the year. So we only have, actually, I should update this slide. There's 12 weeks left this year. And 5 of the 10 best weeks on record, on average, since 1950 are actually in front of us still. I can also illustrate that pictorially here with the returns in October, November, and December on average since 1950, and also on average over the last 20 years, over the last 10 years in green. But importantly, in midterms, which is like the one we're in now, we're in a midterm election year, that's the black bars. And then you get very nice returns. Now, I'll just say with the midterms, the betting websites are thinking the Republicans might win the Senate. They will definitely win the House, but now it's looking like they're going to win the Senate too. Stock market's telling us that as well. Stock market, this is a brokerage called Strategas, and they have a portfolio that would benefit from a Republican Senate, or a portfolio that would benefit from a Democrat Senate. The Republican one's going up and the Democrat one's going down. So the market seems to think the Republicans are going to win. Regardless of who wins, typically, this goes back to 1928, in a midterm election, you have sideways performance for the 12 years leading up to it, and then you have quite strong returns in the 12 months after it. Just an average, but for whatever reason, I think people don't like the political uncertainty going into the midterms, but also usually the White House incumbent, their party loses the midterms. And the market likes it when you have a divided government, because I think the logic is that you get less fiscal stimulus, therefore less inflation. And also the politicians are so busy bickering amongst each other, they can't create layers of red tape and whatnot to get in the way of the corporate sector. The retail investors are very bearish, so we can see the ratio of puts to calls. The blue line at the bottom is at 3 times. There's 3 times more puts than calls for odd lot investors, which is the highest on record. You can also see in the past when you got big spikes in the put call ratio, it tended to coincide with the market bottom. Institutional investors, well, I should say, no, this is still retail. American Association of Individual Investors does a survey. Are you bullish or bearish? The percent saying they're bearish is the blue line on the bottom, and it's basically the highest on record. I think if you look in the middle, global financial crisis got a bit higher, but once again, when you get to that dotted horizontal line at the top, and you just look at where that was, commensurate with the S&P, it tended to correspond with bottoms in the S&P. Then on the institutional side, Bank of America, as I said, does a fund manager survey. So I showed you one slide earlier, what percent think the global profits will improve, and it was like none. Here we can see similarly, their fund managers surveyed see more risks than even in the global financial crisis, which is a contrarian indicator. I mean, it means they already see massive, massive risks. They're already very, very bearish. And the percent expecting a stronger economy, which is really down here in the dumps on the bottom right. If you look at that alongside the stock market, which is the light blue line, you'll see the red circles that only in one occasion, once again, I go back to the global financial crisis, July 2008, was a bottom in the percent expecting a stronger economy 12 months forward. And yet the market continued to go down after that. But all the other times, basically, that was the bottom in the market as well. So if we get a Lehman Brothers, yeah, we're going to go lower. If we don't get another Lehman Brothers, I think we're going higher. I don't think we're getting another Lehman Brothers. On interest rates, here is the same fund managers. Now, back in, I don't know, June, no, maybe it was back in May or April, 6 months ago, we can see the percent who felt that interest rates would be higher 12 months from now was at 90%. Still, there's a lot more who think rates will be higher 12 months from now than lower, but it's gone from 90 down to 70. And you can see that the percent thinking lower was gone from 0 to 30. And clearly those lines are moving, toward each other. So the street is also increasingly starting to think, you know what, I think the Fed is going to pause. And I'll also show you here, Bank Credit Analyst does a capitulation indicator. I put here what the things are in it, but essentially we are where we were before Lehman. If we get a Lehman, we go lower, but otherwise we shouldn't really go lower than here because we never have before. I'm rounding off, but I'll just show you each dot here is a year when the S&P was down from the previous 12 months. So the 52-week high, 52 trading, 250 trading days a year is 52 weeks. So each dot just shows you years when the S&P was down from its 52-week high. What I would simply say is where we are now is the red vertical line. So actually that was where we were a couple of weeks ago. The actual absolute bottom in the S&P was on the 12th of October at a minus 25.4% drawdown. That's that vertical red line. And if you just kind of eyeball the other little dots that are on that line, or maybe over to the left of it, basically very, very rarely were your returns 1 year later, and that would be the y-axis from the top to the bottom over on the left. Very, very rarely were they negative. That would be that lower left quadrant. We can literally count them, whereas all the other dots is pretty hard to count. So I could just tell you, because I don't want you to waste your time counting them, that when you got to minus 25%, which is that red dot in the middle, your chances of being up later, 1 year later, were 80%. Let's say I'm wrong and it goes down another 10%, so we go down 35%. If you look over to the left, when you hit 34%, your chances of being down 12 months later are 0. 100% of the time it was higher. Another thing I would just say, you might know Kathy Woods and her ARK fund. Well, that's down 78% from its peak, which is interestingly exactly the same as the NASDAQ went down from its peak in 2000 to 2002. And the last thing I'll say about the stock market, just to sort of poke fun at one of the big bears, is whenever they bring Nouriel Roubini out, you always know you're getting close to the bottom, because he got one great call, which was the global financial crisis. But literally every year since then, he's been also calling for the end of the world, and so far it hasn't happened. So the fact that the media are bringing out Roubini again, to me, is a strong signal. I will touch on Asia very briefly before I wrap it out. I'll simply say that the yen is down 35% from where it was a year ago. I think it's a tremendous buy. I don't know if it's the bottom, but Japanese assets are fantastically cheap. We put together a basket of companies that we think are very high quality, because most of Japan I actually wouldn't touch, and I'm happy to tell you in more detail after the presentation. But there are some companies that are world class. These are some of them. I mean, there's like over 7,000 listed companies in Japan, so it's a big universe, but I've only put in around 12 here. When we run that, even dollarized, including dividends, it has outperformed the S&P over the last 5 years. It's the blue line. The S&P is the brown line. Pretty hard to outperform the S&P. Very few indices can do it. So quality Japan, I think it's a great time to buy some quality Japan. China is just a huge tragedy. If we rewind the clock, we had a NASDAQ in Asia. It was, JD.com and Alibaba and Netflix and Tencent and Meituan, etc. So it had this closed ecosystem, internet ecosystem that 1.4 billion people were using, and they couldn't use Google and they couldn't use Facebook. And what happened was, I think that a bunch of things. These companies were putting pressure on moms and pops, on society in general. They were getting very rich. Jack Ma at his peak was worth about $70 billion. Their data was far superior to the data that the government had, and a bunch of other things. So there was a massive crackdown, which was actually right after Jack Ma gave his speech in November 2021. So actually somebody realized Xi Jinping really does read everybody's speeches, and he tends to have a bit of a temper. So I think that it's not a coincidence that the big crackdown came just a few weeks after Jack Ma's speech, but it came. The other thing, though, I think is that this policy of common prosperity, wealth redistribution, Chinese modernization was the big term used in the Congress last week, basically is a response to the disastrous demographics of China. And the cost of raising a child is more expensive in China than almost every country in the world. Consequently, I read a survey a few months ago, 45% of young women in China say they do not intend to get married. So they're not going to have kids. The birth rate is this. So the average age in China is 38, which is, by the way, exactly the same age in America. 38 is the average. But in 30 years, the average age in China, demographers say, will be 56, and America will be 44. Now, there's also the fact they didn't remove the zero COVID. And what I would say there is some anecdotal evidence that they're probably moving in that direction. So I think it will come off little by little, but won't be really enough to get the economy going. The stock market has been totally derated. Alibaba, which used to have a price to sales ratio 3 times larger than Google's, today has the same price to sales ratio as Campbell's Soup. In other words, it's never going to have any growth again. Is that true or not? I mean, I think, frankly, as long as this policy and this set of government remains in place, probably is somewhat true. And then you've got the fact that China's stock market, not just China, but many Asian stock markets are very weighed down by the deadwood of state-owned enterprises. So this is just the top 25 of the 50 largest companies in China. The red ones are the state-owned companies. But if you add them up, they're actually a quarter of the index. And they're not run for minority shareholders. They're run by civil servants who are not, paid really based on their performance. So I would just say China's a macro trade. When we see the government bond yield rise, that'll be a sign that better times are ahead, because the bond yield will be rising in response to, better economic conditions, probably through stimulus. But there's no sign of that happening in the bond market right now. And I would just say, in conclusion, that the saddest thing for me is Hong Kong, because this is a 30-year trend line, and it was broken yesterday. So Hong Kong, even in the Asian crisis, even Tiananmen Square, even, global financial crisis, it always managed to avoid breaking this line, but it did it. And so this is, in my mind, actually the a stock market in the world with the most distressed prices, because it's trading on 0.7 times book, which it never did if you look on the left in the Asian crisis, never did in the global financial crisis, but it did. It has done that now. I don't really know what more to say about it, except that it is extremely undervalued. And there are some good companies in Hong Kong that are not China plays. Like an AIA or a Samsonite or a Hong Kong Telecom, the REITs, and they are very, very cheap. That's what I'll say. But I would say that you can always gauge, I think, the return on capital of a country by watching what its rich people are doing. And I'm interested to, but also sad to see that Tencent has made hardly any investments in China this year. They've made 27 overseas, and they say they're reorienting their M&A strategy to focus more on overseas. Frankly, Southeast Asia is not that much different. This is the largest department store in Thailand, Central. They just announced they're going to be spending $1.3 billion in Switzerland, Austria, and Germany. And no offense to Switzerland, but when Thai billionaires think that it's got a better growth prospect than their own country, that's really telling you something. But I will end on a happy note, which is to say that India, Tata Group, largest company in India, are investing $90 billion in India over the next 5 years. They have spent the last 20 years trying to get out of India. They bought everything from Tetley's tea to Range Rover, Land Rover, Jaguar, steel companies in Korea, just everything. It was sort of messy, but now they're coming back to India to build high-end things, electronics factories, semiconductors. And by the way, Apple are moving iPhone 14 production to India. They have made iPhones in the past in India, but they never made the latest model. And you can see at the bottom, JP Morgan think that by 2025, 1 in every 4 iPhones in the world will be made in India. So I'd be happy to speak more at length about India or any other place you'd like, but I should finish it off here. So I'll just exit, stop sharing my screen, and pass it back to you, Callum. Thank you.
Thank you, Mark. That was incredible. Just have you ever thought about including more data in your presentations?
Oh, I've that's only half of what I've got. I guess you meant that as a joke. Okay. Yeah.
I did. It's incredible.
Sorry, it took me a while to get that.
No, incredible. And every slide I had questions, but yeah, look, I mean, you finished on India, so I think just geographically right now, I'd be interested to get your thoughts. I mean, India demographically got a nice young population, and interestingly, doing very well as in leadership positions around the world, in both politics and tech companies, amongst others. So you seem quite bullish on India.
I am, and it's an expensive market with one brief exception, which was the bottom of the global financial crisis. It's always been more expensive than its peers. The interesting thing to me is that this year, India in rupee terms is flat. In dollar terms, I think it's down about 10, perhaps a bit less, but that makes it an outperformer. Now, in 2008, India fell 55%. And the S&P fell 35%. So it underperformed, even though the global financial crisis had nothing to do with India. And the big difference, I think, is that foreigners leading up to 2008 had been buying lots and lots of India. Over the last few years, they've been selling lots and lots of India. And India has a big local domestic investor base that it didn't have before, both institutional and retail. So to my mind, it's a very different market from what it was, say, 10, 20 years ago. It has done big reforms since 2016 with goods and sales tax, demonetization, bankruptcy act, bankruptcy court and real estate act, and a bunch of other things that basically were meant to make companies behave better and drag the small and medium-sized enterprises into the official economy. And it took a few years and resulted in subpar growth because it was a very cathartic and painful process, but it has been achieved. So now tax collections at a record high, and they're using that money to actually, do good things with, build highways and airports. And if you've been to India, I don't know if you have recently, but their airports are great. They've got very good highways. They've got metros. Bombay, they're building a metro, but they have them in Delhi and Chennai and other places. And then the demographics, as you said, well, 5 years ago, the working age population exceeded the dependent age population, and demographers estimate that will last until roughly the year 2055. And when you look back in history at other countries which went through a similar process, Japan, that happened in 1964. And I think we all know that, that broadly, the next 10 years, let's say 64 to 74, great years for Japan. Korea was 87. So 87 to 97, great years for Korea. China, that happened in 94, 94 to 04, great for China. So there's this demographic component to India, which is very helpful as well.
Yeah, definitely. And look, you seem I guess quite bearish on China in general, with combination of COVID, and obviously the markets weren't too impressed with what was happening last week.
Yeah.
China's really been the engine of the global economy for in a lot of ways. It's supplied a lot of the growth for the last 20 years, I guess. Where do you see that coming from next?
Well, I think this year has been revealing in so many ways, and one of them is that we were all led to believe that China was responsible for about a third of global growth. That's the number I always bandied about. I simply don't think that's possible in light of the fact that their economy is ground to a halt, and yet the rest of the world hasn't. So I think either that number was incorrect, or a lot of the growth was really indirect. In other words, yes, they were doing lots of trade with Southeast Asia or with Latin America, but ultimately the buyer of those products was the United States. They were just making things and sending them to the United States, and that buyer is still there, the US consumer, and the consumer elsewhere in the world that was buying Chinese products too. My concern with China is that out of the Party Congress, we got quite a bit of things, but one thing that we did get was a lot on Taiwan. And they also changed the constitution. So the Communist Party has a constitution. There is a military part of that constitution, and they put in some verbiage on Taiwan, which escapes me now, but it was something to the extent that, reunification is going to happen. And Anthony Blinken said last week, and I think an admiral in the US Navy also followed that, the timetable for reunification, they think, has been significantly accelerated, judging by, I don't know, do they have intelligence as good as they have in Russia and China? I doubt it, but maybe they're just reading the same things we are and they've come to that conclusion. But my concern is that we saw what happened in Russia. If you owned Russian assets, you were frozen. You couldn't sell them, you're stuck. And I think a lot of fund managers are worried that if there is an eventual confrontation over Taiwan, that you won't be able to get your money out of China too. So it's a very cheap market, but that risk of literally not being able to get your money is just way too much for most people to handle. Now, in the event of a war, I'm sure everything, including the S&P, would immediately go down 30%. But unless it's a nuclear war, I think that the S&P will come back very fast, and many other places will too, but probably not China, because that is where the theater of the war would be. Yeah, it's hard for me to say much good about it, and I can only hope that I'm very wrong.
I'll do one more country before we get on to, we've got some good questions coming through. I guess the other question, other country that's in the news at the moment is Russia, and what's going on there. Do you see Russia ever being a viable investment option again in the foreseeable?
Oh, absolutely. I mean, I went through the Asian crisis. I was in Bangkok at the time, and really the view was turn off. Last one out. Just what's the expression?
Turn the lights off.
Turn the lights off. So that nobody thought there was any future for Thailand, Indonesia, but there's a fabulous future. So things can change. And I mean, one thing I've sort of figured out over the years is predicting the future is absolutely impossible task. So I can't try to do it. But I would also say usually it doesn't work out the way you think it will. So I'm no Russia expert, and I better leave it at that.
Well, let me come to some of these questions. So from Jemana, what trends can we expect from the current market dislocations in venture capital investing next year, 2023? You been looking at venture capital at all?
I mean, the problem is that, number one, I'm not speaking about something I know a lot about, but I do believe that private markets, including venture capital, were so successful, had such high returns over the last 10 years because of low interest rates. And so there was a lot of leverage. And so venture capital specifically, I can't really comment on, but generically, private markets now have to have much lower valuations because that leverage is much more expensive. I mean, I just showed you a mortgage has gone from 3% to 7%. So you know, I think the last really big deal, I'm sorry, I'm not addressing directly venture capital, but just generically on private markets before the big rate hike cycle was Dunkin' Donuts. And I'm trying to remember, I think Dunkin' Donuts, that deal was done something like over 20 times EV to EBITDA, which is just insane. I mean, the multiple should be sort of around 5, even at its highest, maybe 6 or 7. And so like that's all gone now. I don't think it'll come back, because having said that inflation's going to come down, it won't go back to 1%. It'll probably settle, if we're lucky, about 3. And therefore, interest rates will be structurally higher than they were over the previous 10 years. And so everything has to revalue. Now, I think the equity market and certainly the fixed income market have already done that. But the private market is obviously far more opaque. And so the evidence, you know, it's going to have to do the same thing. So you know, with every market, including private markets and including venture capital, it's sort of like what they say about property: location, location, location. So if you've got a good deal, it's a good business, got strong cash flow, then it's good. But you know, a lot of the stuff that was going on wasn't like that, and that's all history now.
Yeah, I think I mean, private equity is kind of the last numbers I saw, they're still sitting on over 2 trillion of dry capital, theoretically. I think venture capital is a much smaller percentage, much smaller. But yeah, I think some of those private equity deals that were heavily leveraged are going to be sort of at risk with high interest rates and increased costs. And I think that's kind of answered. So one of the questions from Isaac was, do you see inflation going back to 2%? So you kind of answered that. You think it'll drop back to around 3?
Yeah, and I mean, you know, that's just it's a guess, but just because, you know, deglobalization, war, and we can see the reshoring happening. This year, 350,000 jobs are being relocated by American companies from where they were overseas to onshore in the United States. And next year, the number will be much higher. And those are factory jobs. They're jobs that haven't existed in the US for probably 3 decades. So you know, I'm sure that companies can help to reduce costs through automation, technology, et cetera. But ultimately, things will cost more if they're being made in the United States than if they're being made in China.
All right, and just 2 quick ones because I'm kind of conscious of time. So from Roberto, India is set to become the largest middle class globally. In terms of investment, where could the small investor take advantage of it? Should the focus be in manufacturing, product, retail? Any suggestions for an investor looking to capitalize on India's growth?
Well, you know, there are stocks, bonds, and there's private market in India, and so if you have access to the full gambit, then I would recommend looking at the full gambit. But it's harder to access Indian private deals and fixed income. So I'd simply say for the stock market, that I wouldn't try to be too much of a rocket scientist. I just feel the economy will do well. They'll become richer. So buy the index. I mean, it is weighed down by some state-owned enterprises. So, I mean, there are managed funds that would do would be able to, you know, let you have less exposure to state-owned enterprises. So you could go through the managed funds, but I would be perfectly happy just buying an India ETF. I see no harm in that, you know.
Yeah. And a final question from Kenneth, and I'm kind of paraphrasing because I'm not entirely sure I understand it, but overall, I think your presentation was pretty bullish, certainly on, I mean, even from the second slide, sort of showing that typically after a down year like this, stocks and bonds go up. If we're wrong and it goes the other way, how would you suggest people prepare? Is it just escape to cash, or what?
Yes, I mean, well, you know, the world is, there's so many moving parts. So once, as I said, it's impossible to forecast. But I guess I would say it depends on your base currency and what that is, because I would have a preference to being in gold over most currencies. And as much as gold has not done very well this year, it's done better than most currencies. So I don't think it's done as well as the dollar, although I'm pretty sure it's probably just flat relative to dollar this year. So you wouldn't have lost a lot. But you would have made money in pretty much every other. You would have been much happier owning gold than euro or gold than yen. Now, I just said I think the dollar is peaking, but once again, it is a topsy-turvy world. I don't know 100% for sure. So I think I would say that if you really want to you know, just stay on the sidelines, I don't think gold is such a bad place to be.
Yeah, and sorry, we just got one last question has come in about Southeast Asia. Do you have any views on property prices in relation to likely declining interest rates? And along the same line, do you see an increase in M&A activities in Southeast Asia?
I can't answer on the M&A, I'm sorry. And even on the property, I mean, it's a massive region, isn't it? And every country is different and every city is different. But some of the property markets are very illiquid and intransparent. I mean, Bangkok is a massive city. I don't know how many people are there, but there's no property index, there's no historic data. So you can get a kind of sense of the way things are moving, which, by the way, in the case of that market, has just been stagnant for the last few years. So I actually do think Bangkok property is pretty good value, but then you got to make the asset productive. I mean, who's going to rent it? And it's a hassle, blah, blah, blah. Mm-hmm. So I have no real strong conviction on any of them, apart from, ironically, Singapore, because it is different from the rest. And I do think that it's going to the world's going to continue to be a pretty hairy place, and people will look for safety, and so it's the safest place in Asia. Yeah. And I personally don't think property prices here are so very expensive, but as a foreigner, you have to pay a very large stamp duty, so that it's sort of hard to access as a foreigner.
Yeah. Mark, thank you so much. As always, yeah, incredible range of data. Just every slide blows my mind. I feel like I need to go back and watch it from the start again. So thank you very much. And I know I say this every time, but let's not leave it so long before we get you on again. And look, maybe we can do this in person. That would be great to catch up.
That'd be much better.
Yeah, awesome. Thank you very much, and thank you to all of our attendees. We yeah, had lots of people on, some great questions, and so thank you for everyone. See you all soon. Cheers.